Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, September 19th, 5:24 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we continue to be in a correction. You see at the trend gauge over here in the upper right, all five of the major indexes are below their key time frame moving average that we use to track them, meaning they're all below their short-term 21-day exponential moving average, their medium-term 50-day moving average, the long-term 200-day moving average. Leaders holding up better than the indexes, still no problem creating a 21 over 21 list. And we'll take a look at around 10 tickers or so today that are still holding up the best. So what happened today? Kind of normal in a bear market after 3 out of 4 days down, including a big negative reversal after the CPI inflation data last week. Today we had a bounce into the 3,900, formerly support, now acting as resistance area. First step to a recovery in the market would be to get back above this 3,900 area. Taking a look at the indexes, our in-house G6 growth proxy ETF composite up 0.54% on the day. S&P gap down 0.85 on the day. Nice positive reversal, closed up 0.7. In fact, all the indexes gap down between 0.8 and 1.1 on the day, but all finished firmly off of their lows, which means this 3,800 and change area is solid support for now anyway. We'll take a look at that when we take a look at the charts. NASDAQ 100 closed up 0.8, Dow up 0.64, mid caps up 1.2, Russell 2000 small caps up 0.8, Global Diversified 60/40 stock and bond index up 0.31%. In-house, early in the day, we took off the rest of our SARK inverse ETF. That's the inverse ARK-K. Booked a gain on that on the day. We were up 0.03%. We'll get to the tail of the tape and the charts momentarily, but first let's dive into what we do here at Revere. A lot of people like to criticize people that follow the trend, saying that it can't be done. I say, don't interrupt somebody that's doing what you're incapable of doing. Let's start off with the S&P 500 here. Here's basically our simplified rule set here at Revere. If you look back to last October, November, the major indexes were trending above their short-term 21-day moving average. That's the green line. Their medium-term 50-day moving average. That's the red line. The long-term 200-day moving average. That's the critical black line. When things stop trending above there, pull back a little bit, go sideways, the market is our stops are going to get hit. The market will take us out. It won't be a conscious decision on our part. We have a set of rules for taking profit, some offensive, some defensive. But if we start rolling over, our defensive sell signals are going to kick in. Here you had a false breakout. We got involved again in the market. Then we really started to roll over once the calendar rolled over to 2002, and we started breaking our short-term, medium-term, and they started rolling over. When the slopes of the line roll over, we get more concerned, we get more defensive. When we break below the black line, the 200-day moving average, this is when we understand that risk is very present in the market, and we dial back big time on our exposure to the market. You can see a couple times here during the first quarter, we battled back and forth between the 200-day moving average. We were in, we were out. When we get above the 21, even though we're under the 200-day, that's our short-term buy signal. So we'll start putting some more money in the market. You get above the 50, that's another buy signal. We'll start putting more in the market. But then we rolled over again below the moving averages, and then April 21st was a big change in trend. Not only did that mark the top of the line, the 200-day moving average, which started rolling over after then, it also marked the beginning of the second leg down in the index. As you can see how harsh we dropped here over a period of a couple weeks. Reflective bounce, another lower low, tried to come off the lows. Then we had a meaningful rally. Started again by getting back above our short-term indicator, 21-day moving average, then above the 50, rode it all the way up. This was a double-digit rally into 43.25, where we ran smack into the declining 200-day moving average, which is now about 5.5% down from where it was when it started to roll over, which means we'll be getting in 5.5% lower than we would have if we had re-entered back up here. So that's one of the advantages of trend following, and one of the advantages of getting to safety when we're under the 200-day moving average. And that's because all 13 of these bear markets, 6 of them have been severe since 1968. They all occur when you're under the 200-day moving average, or on a weekly chart, the 40-week moving average. They usually start around 11% above the 200-day moving average, but when they break below, you never know how low they're going to go. Sometimes they don't hit 20%, and that's fine. We get back above the 200 and the short-term moving averages. We re-engage with the market, but sequence of returns, that is what you get from year to year. It's not a smooth line, 7, 8, 9%. It's very volatile, big variability. And these severe losses, on average, down 44.5% for these 6 severe bear markets. It takes an 80% gain to get back to even. You just can't afford that if you're approaching retirement. And even this year, a 60-40 portfolio, bonds are down as bad as the S&P 500 is down this year. So that 40%, so-called 40% diversified, I'd liken it to having a balanced diet but buying rotten vegetables at the store. You don't do that. Why should you be in bonds that are in a severe downtrend because interest rates are in an uptrend? Common sense is what we're trying to apply here, but common sense isn't always common in the stock market. So what we've got right now, well, let's get to the contact info. If you're interested in more info about this approach, a lot of people contacting us during this year. We're very happy to speak to anybody and everybody and try to convert them to our common sense approach, so you realize you don't have to be at the mercy of the market if it continues to go down. And we've got a great story we're going to share on our podcast this Friday about a new client. Email don@revereasset.com or dan@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Dan would be happy to talk to you about any questions you have about your portfolio or anything financial. He's also great at estate planning. Give him a shout if you're interested in that. So where are we currently? As I mentioned, this low here, this 39, really around 39.15-ish, 38.15-ish, I should say. Didn't quite get there. The lows 38.37, 38.38 were the lows the last 2 days. That's where we've held 2 days in a row and then finished near the top of the range. So that's pretty firm support as of right now. Let's bring up the tail of the tape, and I will point to this area when I get to it. Well, let me get through the 5 indexes first, and then we'll get into the details on the tail of the tape. So NASDAQ 100, same situation, holding at this low here, this 285.60 on Friday, 286.04 today, so 285, 286 is your support area right now. We bounced there, filled the gap, but now we're into this prior support area. See if it acts as resistance as we move forward into the week. And of course, we've got the big FOMC interest rate announcement on Wednesday. Dow Jones Industrial Average is the next index that we'll attack. Same thing, the low here around 30,500, 30,600 over the last couple of days. That's your current support area. Bounced off of that the last 2 days and filled the gap. Mid caps, these have been holding up better than the large caps. You can see we're closer to the 50 and the 21, which just had a cross down today. Some say it's a negative cross. I've also read studies that history doesn't bear that out, that's actually a bearish point in the market. Sometimes it happens when you're down as far as you're going to go. Anyway, bounced off the lows the last couple of days. We undercut, in fact, today. So that makes this an outside bullish reversal on mid caps, and on small caps, IWM. Same situation, closer to the declining moving averages, which means we haven't gone down as far, and you can tell that by looking at this relative strength line over the last 2 weeks. So let's get to the tail of the tape today. We still have these macro headwinds that we've been talking about for all year, basically. And technically, the G6 and the indexes, daily stochastic hooked down. Now we're approaching oversold on the daily stochastic. Some indexes in it, some approaching it. Sentiment 0.94 was really escalated Friday morning at the lows, but coming off, that's on the put call ratio. VIX hanging right around this 26 area, down 2.1% today. Fear and greed at a 37. We're still operating under the bear case. Break of the 21 and rally failure on the 913 CPI, which followed up the 826 Powell strong move down, which started with his Jackson Hole speech, where he said basically, people, listen, we're not raising rates. In news today, TNX, the 10-year, hit 3.51%. That's the highest since 2011. Today, coming in, we had 3 out of 4 down days. Today's our first up day, we'll call it, with a move off of support across on the indexes. And then, of course, Wednesday at 2 o'clock, as I mentioned, we'll have the FOMC, not FMOC, FOMC. Decision and press conference, always good times there, and volatility. So coming into today, my expectations were negative to neutral. Negative because the CPI killing the rally, neutral because we were already down 3 out of the last 4 days. Holding again in the late rally filled the gap. Put a little positive spin on the expectations. As far as support and resistance on the S&P and the NASDAQ 100, up into this resistance range today after support held the last couple of days. And the NASDAQ 100, we got above the support resistance level, actually undercut the support fib, this 286.82 area, and then back above back above this 290 area. We closed at 291.05. So undercut and reversal, undercut and reclaim of the support area, and then above the support resistance area. Bottom line is positive action today. You can't complain about it at all, but it was after 3 out of 4 down days. One thing to note, when this gap down at 0.85%, that was like the low of the day within the first couple of minutes. So that again is more ammunition that the market was sold out for now, and a bounce ensued. We tried to test that a couple times intraday, but all pullbacks were bought. You can see the strong and the weak sectors today. We'll take a look at these charts on the focus list that I have here. I mentioned our portfolio. We're 100% in cash right now with our sale of SARK. Bottom line, today's the second straight day where 31.15 support level held, and we closed near the high of the day at 3,900, which was a resistance area. Let's see if was a support area that was broken on Friday. See if it turns into a resistance area. You can see here I'm highlighting this 38.13, 38.15 key area, which we got back above in July 15th. Most recently testing it late last week, and it held. That's 20% year-to-date down, and it's also this key 38.2% fib level. These technical levels matter. People just thumb their nose at them, but trust me, there are thousands of algos coded to look at these types of things and make decisions based on whether or not you're above or below them. So we're right here now in this 38.87, 39.20 major support and resistance area. May, June, July, September, battling back and forth all over it. We're in this range right now with this close at 3,900 today. 38.97 our prior close. The most recent lows is what we want to hold, and that's an area we'll be watching when we get the FOMC announcement and presser and reaction on Wednesday. So let's take a look at some charts. And the first thing we're going to go through is when I closed the 21 over 21 on Friday, we only had 15 stocks there. Let's go over the 6 that I've added since then. Mixed results on them today. ENVX bounced right off the 21. That's just what we want something to do. Albemarle undercut and reclaim the 21 on Friday. Nice bounce off the 21, a nice 3% move up today. Northrop Grumman, a defense stock, really tight for a while here. You can see it undercut the 50-day moving average middle of last week, but made a 5-6-day high today. WCN, pollution control has been a pretty good industry group lately. Breakout, it's a breakout that hasn't failed miserably. It pulled right back to the pivot, which quite a few breakouts do, but look at this relative strength line on WCN. Very nice above the 21. That was stock number 4. Number 5 was one that was on a few weeks ago, returned today, returned on Friday. Plug Power closed right on the 21 today, not showing a bunch of strength over the last week and a half, but still one of the better charts out there. A big move on volume above 30 would be something to certainly take a close look at. And a new ticker, CHPT, ChargePoint Holdings. In the EV space, alternative energy, basically everything in this energy alternative energy space is acting well with the billions of dollars they're throwing at it from the Inflation Protection Act. Funny. As you can see, a big cup and handle forming here. Failed at the 20, pull back the last couple of days, but this looks pretty good. So those are the 6 that were added to get us to 21. Let's take a look at the 10 that I was focused on. These are the best 10 charts. LTHM, Livent Corp. Big move, 4% off the 21 today. You can see every time it's touched the 21 over the last 2-3 weeks, that's been the low. So, and that's really been the only way to make any money in this market, is to buy at the low of the range or at support, sell it when you get up to resistance. Anybody that has tried to buck that trend and continue with follow-up breakouts, with a very few exceptions, one of the exceptions is on this list, has seen their gains disappear. So really these charts that we're looking at will have the nice relative strength, weakness when they get to the top of the range, and strength when they get to the bottom of the range. So LTHM was the first one. Next one's going to be Chipotle. I've talked about this for a while. Big relative strength over the last 6-8 weeks. Cup and handle breakout, not so fast, my friend, but the pullback right to the 21, and it bounced there, and the lows held over the last 2 days, similar to the way the lows have held in the market. Tesla, this thing just looks like it wants to go, hanging around here between this 310 and this 315 area. Pullbacks right below 300 have been bought over the last week and a half. End phase, we know solar stocks have been leading. End phase, probably the second best one. Again, anytime it gets near the 21, buyers show up. Anytime it tries to break out above 310, 320, sellers come in. The number one solar stock for solar, one that continues to ride this ADMA higher. But again, you see on 9.8 and on 9.13 try to break above and pull back. This one hasn't touched the 21. This is why I'm calling it the strongest stock in the market. This pullback here to this 130 area was the last best chance to pick up some shares and make some money on it. Wolf, WOLF, silicon carbide, semiconductor. Hey, new high close today, hasn't pulled back yet on this second day up in the market. Maybe this will buck the trend and this will be a leader if the market does right itself. LNG still holding up strong in the nat gas. Field industry group bounced off the 21 day today. BJ's leading retail stock, if you want to get bang for your buck, tried to make highs, pulling back today above the 21. It made its lows. CEG, this is one that so the second stock where you made highs and haven't reversed yet. This one extremely strong relative strength. And finally, Shockwave, SWAV, undercut and reclaimed the 21 today. And then really need to see some strength in Apple. Apple, this looks like a Morningstar pattern where it comes down, reverses. This just means all the sellers are gone at the low. from last week around 148 and change. Strong move up today on above average volume. Volume exaggerated last Friday on a lot of tickers because it was quad witching, so you can't really count that. But this big negative reversal day that it had on 9/13 is so far setting the trend, but we did get back into the same area where that closed on 9/13. So keep an eye on Apple. If it can get back above this 160 area, reclaim these three moving averages, that'd be a very good sign for the market. So that's the 11th stock that I'll be keeping my eye on, and that's going to wrap it for today. As always, love to hear from you. Don at revereasset.com. Any comments, questions, or complaints, or phone 855-REAL-WEALTH. That's 855-732-5932. Remember, folks, it's not how much you make in the market, it's how much you can keep. It's why we make risk management our primary job, our job number one here at Revere. You take care of the drawdowns and the returns take care of themselves. Plus, you get to sleep at night knowing that you're not going to get hit across the back of the head with the 2x4 that a bear market can yield, or wield, I should say. So wrapping up, Monday, September 19th, this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.